take our conversation forward. Sanjeev, it's turning out to be a dream year for every market participant. As we unwind the year, will the dream turn into a nightmare given what is happening to commodity prices, bond yields, and FI selling?
It doesn't look like, because look at the market, obviously it's expensive, somewhere about 22 times almost on a March 23 basis now. So clearly on the expensive side. But having said that, I don't know what could be the big negative trigger which will result in a big derating of the market. Yes, bond yields will move up. The expectation of bond yields will rise over a period of time. But the expectation as of now is that bond yields will rise in a very gradual manner and moderately over a period of time. So our own expectation is maybe between 50 to 100 basis points as far as India is concerned over the next 12 to 18 months. At the same time, keep in mind the fact that you will also have fairly strong economic revival and earnings recovery on the back of that. So we are looking at about 34% growth in profits of the Nifty 50 index for March 22, followed by another 15% for March 23. So hopefully, whatever increase in bond yields you see, that to some extent gets offset by increase in earning numbers also and earnings yields at the same time. So that's the hope. I just hope, over the next 4 or 5 months, inflation data point, starts turning down globally, which will, result in the market, having a lot more comfort with whatever narrative currently that inflation is transitory and will come off, and central banks won't be forced to bring forward exit strategies in terms of, raising interest rates. So let's say keep the fingers crossed on inflation. Unfortunately, inflation looks like it is going to be on the higher side globally. And India, over the next few months, it will start moving up. I just hope it remains, within check and central banks in the market don't get some sort of a root shock over here.
Sanjeev, for someone who's valued companies based on enterprise value, cost of asset, replacement cost, how would you say one should participate in this entire, I'm not using the word startup now because a Paytm or a Zomato now is bigger than a lot of big companies. How does one participate in this new tech company? You cannot ignore them, but if you invest in them, there's this feeling at the back of your mind, which is that, this would be a cardinal sin to buy companies which are loss making and which have no profit projections.
Not necessarily, you have some sense of what the market opportunity is, in most of these markets on a 10, 15-year time frame. The expectation is that, India will grow, penetration of goods and services is still very low. So you can have a reasonably good sense of what is the market opportunity for each of the segments over the next 5-10 years. And from that, you can work backward in terms of, what kind of revenue numbers should one build in for the major participants in that particular space. If you look at, for example, food delivery, we are looking at somewhere about $8 billion food delivery market by 2030. And as of now, it looks like it's a two-play market. So, that gives us some amount of comfort. Obviously, in some other segments, you still don't know what the competitive landscape is like, how many players will emerge going forward, whether the market consolidation order taking place or not. So a lot of variables still out there, which makes it somewhat more trickier, to divide whatever is the market opportunity or TAM, as we call it, between various market participants. So you'll have to look at every segment on a, very top-down basis in terms of sizing the market properly. And then on a bottom-up basis, in terms of the capability of each of these companies to participate in the opportunity. The challenge, Nikunj, always has been that, while the market's opportunity may be 100, the implied market opportunity may be several times that, because each company may be, or the expectation of the market would be that each of these companies will have, a fairly large market share, which is obviously not going to be the case, right? Since the market size is a limited number, obviously that's a constraint. But at least in the initial stages, it is possible that the expectation that, each of these companies will be very successful. So we'll see, how the landscape evolves, how many of these companies eventually, succeed. But the danger is that if you're already implying a lot of market cap and market opportunity, which doesn't make any sense based on the implied market cap of the company, then you have to be fairly careful. So I don't know whether we are there in some of the sectors, possibly. So again, as I said, you will have to look at each of the segments in a very granular fashion and then take a call.
Sanjeev, the dilemma for even our viewers is that which side should they lean? New tech or high growth companies, which obviously are important and relevant, have become big brands in themselves, they are ecosystems within themselves, or one should go back to traditional companies like textile sector is making a comeback, corporate banks are making a comeback, cyclical and industrial cycle has started. What should one do? Because it's very rare that you see so many options where you're spoiled with choice.
Well, that's a good problem to have, right? If you are seeing, opportunities and value based on that, that's fine, I guess. I don't know why that should be a problem. It's not necessary that you are wedded to any particular, set of sectors or, stocks, right? If you find value in even some of the traditional sectors, I guess that's fine. But obviously you'll have to be careful, when you're looking at some of these opportunities, whether they will last for a longish period of time. The danger in India is always that things get extrapolated very quickly. And even for cyclical commodity businesses, the general assumption or the implied assumption is that the commodity prices and profitability will stay high for a longish period of time. I mean, that need not be the case. And the other danger is that based on this assumption, people start giving very high multiples to peak profitability, which is where the real problem comes. So I guess there's no hard and fast rule about these things. You have to do bottom-up math for each of the sectors, each of the stock, and see what is the price value equation. And if it makes sense, then you look at the stocks favorably. If the stock price implying let's say fair value of 100, or rather if your bottom-up fair value is 100, stock price is 150 or so, then why do you need to bother with such companies in that case?
Good morning. Thanks for joining us. This is Nentara. One question I had for you as well is that, later, the macro tech QIP, for example, the Phoenix Mill fundraise, real estate is making a comeback, and how? We've seen a run up in the stock prices. Many of them, like for example, DLF, still below the IPO price. What is your strategy when it comes to real estate? You folks had been saying also that you prefer holding real estate indirectly. Has there been any change in thought of that?
No, we have been quite positive on the residential real estate cycle for more than a year now, actually, and the confidence comes from the fact that over the last several years, the cycle hasn't gone anywhere. If you look at the major metropolitan markets, in fact, the volumes are still significantly lower than the peak volumes in 2010, 2012. And, of the five major metropolitan markets, the monthly run rate in terms of million square feet used to be about 35 to 40 million square feet. We are somewhere about 25 million square feet as of now. So after 10 years, of fairly decent growth in the Indian economy, your residential real estate volumes are still lower than what used to be a decade back. Second thing is residential real estate prices haven't gone anywhere for the last 7 years now, starting from middle of 2014, pretty much flat across all the major markets. And the third thing is EMIs are down significantly. The average interest rate, let's say mortgage rate used to be about 10% plus in FY15. Currently, you can get something for less than 7% now. So that's about 15-17% savings on EMIs. If you put everything together, affordability is up significantly. EMIs are down. And after COVID, I guess everybody wants to upgrade their house, I guess the cycle can be fairly strong for a fairly long period of time because residential real estate cycles turn out to be fairly long, right? It's not as if you see 1 or 2 years recovery and the story is over. I think it can be a multi-year investment cycle as far as residential real estate is concerned. Now, how you play it, you have various options. You can play the real estate company, which have done very well actually with the last 6 months, 9 months. Many of them are up significantly. You can play through the construction material, building product companies. We have housing finance companies. Some of them are still reasonably valued. So we have various options to play the residential real estate cycle theme.
Yes, that's what I meant by indirectly, because so far that is the strategy that seemed to have been at play, and the favored one as well. I want to just go back to the point that you were also making as far as the new tech IPOs and the e-commerce companies go. If you see the Paytm IPO sail through, whether it pops or not, but continues to do decently well, and is the last one of 2021. The next wave will have the Olas, the deliveries, the Baiju's, but that's expected in the next calendar year. What is all of that going to mean overall for the traditional companies in those sectors? For example, if you have Paytm with respect to allocation to banks, when it comes to Zomato, etc., with respect to the likes of Jubilant FoodWorks, etc.
I don't know whether anything really changes in that sense. Again, you'd have to look at each company, on its own merit and see, whether that makes sense from your portfolio perspective or not. The good thing is, it's not as if, you have to take a call on one versus the other, right? We may have more stocks in a portfolio, assuming, they all make sense from a valuation value perspective. Of course, we'll have to see, how many of these companies eventually turn out to be successful companies in the sense, they create value over a period of time. Because as of now, expectation is that they will have disproportionate market share. They will, execute well. They will take market share incumbents, and everything will work out fine. Whether the narrative plays on or not, we'll have to wait and see. And it's not as if the incumbents are, going to roll over and die, right? Unlike, let's say, 10 years back, when the incumbents were not that well prepared. I think, the whole disruption theme has been, talked about quite a lot over the last 5-7 years now. And so if the incumbents are still not prepared, I think they have a problem in that case. But I assume, most of the incumbents, when it comes to, let's say, private banks, for example, they know, what is coming over here in terms of competition from fintechs, whether it is on the payment side or on the lending side. So accordingly, they will, have their own strategies in place with respect to technology, talent, cooperation with fintechs. I guess, various banks will have their own strategies in place to fight the incumbents when it comes to, to fight the newcomers. So they have ceded grounds to, the fintech company when it comes to payments. I'm not too sure whether that's the case in lending also. And the last point I will make here is, keep in mind the fact that India is still in a very early stage of the economic cycle, right? You have basically a $2,000 per capita economy that will hopefully grow for a very long period of time, 3-4 decades quite easily. So I guess there is some market opportunity for all players at this point in time. Obviously, the smarter ones, who have the right technology and talent combination will do well. Others will struggle, but I guess that's the nature of the market.
Sanjeev, the one thing that stood out from the second quarter commentary has been the inflationary cost pressures. How do you think India Inc. is going to manage to mitigate the same and still maintain margin trajectory? And from an investor's perspective, should you be looking at inflationary sensitive sectors at all right now?
See, the worst effect of inflation has been seen on the consumption names, right? Whether it is automobiles, whether it is consumer staples or consumer discretionary. That's been the biggest impact. Otherwise, in the banks, it doesn't really matter. IT services doesn't really matter, barring whatever inflation you're seeing on the salary side. And commodity companies anyway, they stand to benefit given the big increase in commodity prices. So other sectors are broadly fine. Now, consumption sectors, the good thing is they do have pricing power, especially consumer staples and discretionary. They will increase prices over a period of time. Obviously, not possible to raise prices significantly in 1 quarter alone. But many of them, as we can see, have been gradually raising prices from April itself. Every 1 or 2 months, they will announce a small price increase. And given the fact that these are essential products, I guess, the consumers have no option but to, to absorb them. Other way, consumer staple companies at least will manage this issue, the grammage issue. Obviously they will not raise prices significantly, but they will probably shrink the grammage. They will not change the price point, let's say 5 or 10 rupees, which are critical for consumers in rural areas. They will not change that, but okay, they will adjust, through lower grammage for the same SKU. So through a combination of various things, at least I am quite comfortable with the fact that most of the consumer staple companies have enough pricing power and they will manage the big price increases that you have seen on the RM side. Auto company is a little bit more challenging because the demand environment itself has not been that great, at least in some segments. But there too, I assume, over a period of time, price increases will come through. And another good thing which has happened is the government did cut excise duty on diesel and gasoline quite significantly, if you recollect. So all that also results in lower, cost of ownership as far as automobiles are concerned. So all put together, maybe now the automobile companies are in a somewhat better position to increase prices. So broadly speaking, yes, it's been a challenging time. Second quarter saw a big compression in gross margin and EBITDA margin for most of the companies in the sectors. But I think, over a period of time, price increases, sufficient price increase will be done, to mitigate the negative impact of the RM increases.
Sure. Sanjeev, the other thing that I wanted to talk about is the reopening trade. While many have caught on to it already, and we've already seen as to from the multiplexes to the hotel industry to even aviation for that matter, how some of these stocks have actually recovered from their 52-week lows. But is the story and the theme still underpriced? And can it stretch beyond the obvious names?
So it's a good question. I suspect a lot of good news is getting priced in now. Because if you see the multiples of all these companies, they have got related significantly beyond what they used to be, let's say, in before the pandemic. If you look at, for example, any of the hospital companies, the kind of multiple they're trading at currently looks like a lot of good news respect to not just the reopening part, but also, potential value creation in the online pharmacy space, etc., is also getting captured. So, in fact, if you look at the multiples for Polo, for example, this used to be a 40 P kind of a stock on a 12-month forward basis before the pandemic, and it's gone to something like 70, 80 now on a 12-month forward basis. So it's a general struggle with respect, and same thing, lab companies, if you look at, same 35 P has now become 75 P in case of Dr. Lal. So that's the challenge, the multiples have just expanded, beyond the comfort levels in many cases. Same thing applies for the alcohol beverage companies also. But there, I guess the mitigating factor is that, you don't know what the volume numbers could be in another 1 or 2 years' time, because even March 20 got affected. March 21, obviously, was a terrible year. Even March 22 has got disrupted significantly. So I don't know how much of recovery in volumes the analyst community is building in currently. At least in our case, I think we could still be conservative on the volume numbers, assuming travel, tourism, hospitality comes back significantly in the next financial year, which it should. Looking at the fact that COVID situation in India has improved quite dramatically. Yeah, so the theme is pretty much intact, no question about that. But I think, a lot of the good news and more is getting priced in, at least in some of the parts of the reopening plays.
Sanjeev, we're going to leave it at that. Always a pleasure talking to you. Thanks so much for